Hello, 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 hello. What's up, class? How y'all doing? Everyone set, ready? Got your notes out? Getting ready to get this thing rocking. Hello, Jacob. How you doing? Hello, Jason, Ruben, Brethren, Brethren Ken. How are you? Let's get ready for some revelation knowledge. We're going to be talking about the infinite banking concept, all right, which is the next step in someone's personal finances, especially if you're doing velocity banking. The infinite banking concept, in my opinion, is like velocity banking 2.0. All right. So it's really going to be a really cool lesson today. I want this to be very open ended. Ask as many questions as possible. Okay. Whatever questions you have, throw them in there. I'm going to be looking at this concept from an educational standpoint, not a sales perspective or a sales position, whether you should or shouldn't buy it. I simply want to look at the concept, I want to analyze it, and I want to figure out, does this thing make sense? Right? Does it make sense? What is the why? What's the purpose? Where does it get me to? What does it allow me to do as an individual? Sound good? Hello, Ahmed. Hello, Raul. Albert, how are you? Philip, had a wonderful conversation with Mr. Martin today. How are you, man? Carl, how are you? Big guy, ready in the NYC. I like it. Oh, the background noise. Sorry about that. Got family at home, man. They're watching TV. I think I'm competing with Trump right now. I think he's on the news, because the government shut down and a lot of stuff going on with the borders. It's a sensitive time. Okay, very sensitive time. So, my parents are watching that right now. Here's a food for thought. If you are a government employee, probably not going to get paid. I'm not too sure. But how wonderful for my people who are government employees that are doing velocity banking. You can buy yourself some time by doing the velocity banking method, so that once the government does reopen again, boom, you get your money and then things go back to normal. All right, so let's dive into it. Let's not waste any time. Let's talk about it. So, the infinite banking concept, from the amount of data that I've gotten from other YouTube channels, websites, articles, is this idea that we can use life insurance, permanent life insurance, as a savings asset, to not only build wealth, build your money up safely, okay, but we also have this ability to transfer wealth tax-free, avoiding many costs of investing and avoiding many different fees that come along with investing, and you also avoid taxes. Okay, so let's look at this history-wise. Life insurance has been around longer than the IRS code and the Federal Reserve itself, which started in 1913. Okay, I think the very first life insurance company started in the early 1800s, probably even before that. Okay, and some of the very first products were whole life and term life. Okay, it started with whole life first, I believe, according to the information that I've gotten so far. Then they started selling term life. They would sell these types of policies to widows that could not afford the permanent strategy. They would sell it to the women, the households, the men that would go to war, protect them from a temporary basis just in case anything went down. Okay, that was a very valuable thing. All right. Now, before the actual stock market itself, all you had was banking, insurance, and real estate, right? Before the stock market itself, which started when? Late 1800s, probably like early, no, I think it's probably started early 1900s is when the stock market actually began, which allowed anyone and everyone to have an opportunity to make money. Okay, well, prior to that, you had these sustainable, guaranteed ways of building wealth, which has always been insurance, banking, and real estate. Okay, and then obviously, if you were an entrepreneur, capitalist, right, you had a business, agriculture, whatever the thing may have been. Other than that, that's all we had. Okay, well, now we're living in a day and age, fast forward up until, let's see, 1996. Okay, so from well over 150 years, you've had life insurance that's been around, it's been in the game, it's perfected. You can look at the history in terms of who has used life insurance. Okay, you got Walt Disney, you got Ray Kroc, you got the owner of J.C. Penney, many different movie stars, many different politicians, very successful entrepreneurs in the billion-dollar range and the hundreds of $1,000,000 who acquire this asset, as well as banks themselves, okay, acquire this asset. Now, with all that being said, how does this apply to the average household, you and I? How can we take a massive concept like this that the major corporations use to hedge their money, that major estates of business owners and business moguls and real estate moguls and gurus that make hundreds of millions of dollars, is there a way to bring that to scale into your household of a mom, dad, 2 kids, a household of 4 or 5 people? Is that possible? Is it out of reach? Well, let's look at the velocity banking concept itself. Is that out of reach? I don't think so. It takes time to master it. Would you agree, guys? It does take some time. It took me 2 years just to learn velocity banking itself. Like, just to really get it down where I could have a conversation with people back and forth and be able to answer questions left and right. And now it's been a total of 3 years that I really feel like I'm a practitioner in that concept. And before that, okay, had I never discovered this concept, I don't think I would ever live the life that I'm living right now, nearly financially free, okay? As well as every household that I'm currently working with that is on their way to becoming financially free just from velocity banking. So let's solve for a few things when we're looking at the infinite banking concept, okay? Which is a life insurance policy, okay? This is not an investment. Keyword, this is not an investment. This is merely a savings asset tool, okay? And then we're gonna compare it to some other vehicles that you would normally put your money in savings. And then we'll compare and we'll see which one makes more sense, okay? Okay, so here's what we gotta solve for, is the funding amount. How much money do you and I have to put away into savings? I'll give you my rule. I do a 60-40 split. I follow what my Uncle G says, Mr. Grant Cardone. He says you need to save about 40% of your money into an asset and don't lose money. That's what he says. So a guy that makes, I don't know, 200 million a year probably, and just in business revenue and done over $1 billion transaction wise in real estate, I think he has the ability to speak on this. Matter of fact, another guy by the name of Tony Robbins also talks about the concept of saving, investing, retirement, all that good stuff. So we know it's a very good thing to do. Don't let anyone fool you, please. All right. So the funding amount is referring to how much money you and I have. That 60-40 split, I go by your cash flow. Okay, so what are the four major numbers? Income, expense, debt, cash flow. How much money are you bringing in? What are your expenses? What's your overall debt? Are you debt free? If you're debt free, this concept is going to work a lot better. Okay, if you are not, that's why we're doing velocity banking, right? Okay, and then cash flow basically is after all expenses are paid, what is left over? And then what are you doing with that money that's left over? What are you doing with it? Okay? So, you get that number. Now you want to figure out, okay, how long do I want to fund this thing? Now, here's a prime example. If I'm 23 years old, I got nothing but time. So I can fund this thing for a really, really long time. Okay? Now, for most of the families that I work with that are 45 and up, we don't have so much time left, do we? Okay, we've made mistakes, we lived our lives, right? Okay, now it's time to get serious. Okay, playtime is over. You got kids, you're married, it's time to establish kingdom authority. Let's stop fooling around. You had your fun. Okay, now all I'm simply saying is the amount of time that you wasted, I want you to spend with me over the next 5 to 10 years to reestablish your ability to have that type of fun that you want and not have to leave a burden on the family, on the wife, on the kids. Does that make sense? I hope so. All right. So determining the amount of years is based on your age, your ability to work, right? How many more years do you got left in you to really like hammer down? Okay. And the way that I kind of help that is when you discover the four major questions in life, which is who am I? Why am I here? What's my purpose in life? And where am I going? And then when you're able to establish these questions based off a referencing point, being maybe God, a religion you follow, a principle, some sort, whatever your referencing point is, my suggestion is the deity of Christ is your best referencing point in terms of what and how you should handle your life. We might get somewhere, okay? And then third is the funding ability. How much would you like to fund into your policy every single year? So we've got the amount, right? So we're thinking, all right, here's how much I would like to put away. So me personally, I'm doing $500 a month, starting out. $500 a month. My girlfriend's doing $500 a month. My mom's doing $300 a month. Okay, and I have some other clients that are doing $400, $700, $1,000, maybe as high as $2,000 a month. Okay, everyone's at different levels, right? So you get that number. What is that number based off the what rule? The 60-40. 60% of my cash flow can get used to do velocity banking, and then I can use 40% to save. Okay, this applies to people who are debt free. Okay, that's 60-40. Or this applies to people that have over 1,500 cash flow, because based on all the scenarios that I've done with everyone that's had at least $500,000 or more of debt, have I not proven that with just like 1,500 cash flow on a monthly basis with a proper line of credit, that I can get you debt free in like 5 to 6 years, or probably even less? Not bad. Okay, so then if you were originally cash flowing 2,000 and I took 500 to put into an asset and the other 15 to do velocity banking, we're gonna have some fun. Okay, so that's the funding ability, thinking about, all right, here's how much I have now, Here's how much I would like the ability. Okay, prime example, my girlfriend's putting in 500 a month, that's 6,000 a year, but she has the ability to put in triple, 18,000 in any given year. That's a really good start, okay? And the career that she gets should be able to match that, okay? Next is your MEC. MEC, very, very important tool right here. Modified endowment contract. Okay, that MEC right there determines whether this concept becomes an investment or not. Remember how I said infinite banking concept is not an investment. Okay, don't let them fool you. Don't let them thinking that this is the one and done trick right here to financial freedom and wealth. By no means am I saying that this right here is going to make you hundreds of millions of dollars. I would be lying. Go talk to my uncle G. Real estate, my friend, real estate is the end game. Okay? The very first thing that God gave man was what? Dominion. My friend, dominion is referring to a territory. A territory is referring to what? Land. Ha! Not bad at all, right? Okay. So, MEC is simply the funding ability, what we went over. So if you're saying that you want to put in 10,000 a year, and you want to have the ability to double that to put in 20,000, then we're going to design the policy where the MEC will be 20,000. Okay? And then there are some other factors, age, health, okay? And then the insurance company itself. Okay? Next is the insurance company. Who the heck do we go with, man? Now, I know you can agree with me that there is well over 100, maybe 200 plus life insurance companies just in the United States alone, right? Probably more than that. So how does one dissect all of that, right? It's kind of like thinking about which business to join, right? If you're being pitched an opportunity to join a business, it's like, well, which one do I pick? There's so many out there. The way I determine that of an insurance company is based on the purpose, the premise, the purpose of what I'm doing. Okay? So it's very easy to simplify all these life insurance companies down to quite a few. The way we do that is by working with mutual life insurance companies. You have mutual and you have stock. Okay? Mutual and stock. Mutual life insurance company pays when they get revenue, when they make profits, they pay the employees, they pay the business expenses, and then they pay the who? The policy holders, you and I. A stock life insurance company, when they make revenue, they pay their expenses, they pay the employees. The profits goes to the stockholders first. They have to pay them first because they're the ones putting up all the bands, okay? They're putting up all the money. And then the policyholders are last, okay? By you knowing this, you can make an analyzation, a conclusion that, hey, maybe I won't make a whole lot of money with them. Maybe I should just be the stockholder. Wouldn't that be smarter? Now you're talking about markets, okay? If you try to mix life insurance with the market, you might get a double dumb. You got to pay the insurance company and then you got to pay the market. Not so fun, my friend. Okay, so that is one factor of determining which insurance company to go with. Another couple of factors I wrote over here is the financial strength of the company. What are their assets under management, or AUM? How much money they got? Okay? How well is that insurance company doing? The next is their dividends and performance and history. Historically, has this life insurance company performed? Don't go off what the agent says or what the ads say or what the commercials say. You just go up and you Google 2018 annual revenue or 2018 AUM, and you type in the insurance company and you take a look and you're like, they have almost $1 trillion on the assets. My friend, that's quite a bit of money. Now, if you see a life insurance company with $200 million of assets under management, I know network marketing companies that do quadruple that. I know network marketing companies that are in the billion-dollar range. You're probably better off joining a network marketing company, an MLM, and go building a business rather than one of these, working with a life insurance company that has only what? $200 million in the assets? No, that ain't gonna work for me. That ain't gonna fly, okay? So that's one of the things. And then here is the next part of determining the right insurance company to go with. This is now coming down to the agent, okay? The design. How is this concept being designed for you and I? How is it being designed? Is there a practitioner that you're talking to? Okay, this is the internet. So I'm sure, and I recommend a lot of you do this. Research, type in infinite banking, see who pops up, see who's the leader, like see who's doing really well, and ask them questions, see how they respond to you. Do you like what they say? Do you not like what they say? Okay, try to find out if they're a practitioner first, then a salesman. Okay, there's enough salespeople out there. It's when you find practitioners, that people that know how to design this stuff, that's the money right there. Let me tell you, that's the good part. And then last but not least, the agent themselves. Do you know, like, and trust that agent? Do you know, like, and trust me? Of the amount of time that we've been spending together, doing live streams, me creating content for you, we're doing consultations together, we're talking over the phone. Have you come to the conclusion, you know what? I like this guy. I trust him. I know him, and I know he's going to do right for me. Okay? And that is very, very key things to know. So I just took care of that side. Let's turn over to questions real quick so we don't get too lost. Let's handle some questions. Let's see. Okay, what's up, everyone? Okay, let's see. Dimes and 20s. How's it going? First time checking you out live. Mi hermano. Oh, speaking in español. Okay, man, I gotta learn Spanish. It's terrible. I will be looking forward to becoming one of the tier client in the future. Okay, cool. Look forward to having you. Better join quickly because my spots are filling up, man. I got no spots left. All I got is room in tier 2 and tier 4. I think I got one spot in tier 3. And I think that just got taken up today. Caribbean Queen, hello. Quentin, hope everything is going good. Still waiting to get that call from you. I support you and what you do. My friend, did we book an appointment already? I think we booked something. Check your email. John, what's up, John? Brian, how are you? Okay, let's see. I'm trying to find a question. I believe most people are using credit card as a debt weapon to reduce debt and build their credit score. Okay. Is that Malcolm X on your shirt? No, it's me. Oh my God. Can you explain funding amount versus funding ability again? Yeah, Lynn. Remember, the funding amount is referring to how much money do you have, Lynn, to save, right? Because saving's important, okay? To avoid debt, to avoid getting in a pitfall, to avoid having financial troubles. You need to save, okay? Very important. Okay, so the funding amount is referring to how much money do you and I have to put away. The funding ability is saying how much would you like the ability to put into your policy because I'm sure you can agree with me that over the next 2, 3, 4, 5, 6 years, when we become debt free, you're going to have more what? Cash flow. You're going to have more cash flow to do what? Make moves. Make moves. Okay? Carl says, takes 12 to 15 years to build up a decent cash value whole life. What does this mean? Okay, number one, where did you get your information from? Okay, that's the first thing we want to find out, is where are you getting your source of information? Who is telling you that it takes 12 to 15 years to build up a decent cash value? Okay, we're gonna solve for that. I'm gonna go over that. I'm gonna come back to that, but I want you to be thinking about, where do you get your information from? Okay. I purchased life insurance years ago, and it's a combination term and universal. What are your thoughts on that? I'm going to dive into that in a second. What are some of the gotcha this concept? What? Don't know. Let's see. So with these 770 bank account is the ultimate goal, to essentially use the whole life almost as your own bank. Correct. I'm going to dive into that a little bit more. Is what is the purpose? I just went over what to solve for, but what is the purpose? Okay, the purpose is we want to be able to leverage this while we're living to build wealth. Okay, we want to be able to use the money that we save just like we do velocity banking with, in terms of paying off debt. We want to be able to apply velocity banking in our life insurance policy to acquire assets and have those assets pay us back and have no lost opportunity costs in the process. So that's the purpose there. And finally, the legacy portion, which is ultimately the death benefit, which ultimately satisfies your what? Your estate planning, your trust, your will, avoids probate. You get your power of attorney, you get your doctor, you get your this, your that, and the other thing. Oh, these are a lot of things nobody talks about. Everyone talks about accumulation of wealth, right? You got to accumulate, right? You got to build the wealth. Okay, you got to make a lot of money. But what most people don't talk about is what happens when you reach the top of the mountain. You got to come down. You got to come down, right? At some point. So we need it. So the life insurance takes care of this part really well. And it helps protect this part, the growing. Okay. Let's see. Hello, Mr. Lewis. How are you? Good conversation today we had. I currently have a term life policy of $1 million. I have 20 years until it ends. Premiums are pretty low. Give me some options to have a $1 million policy your way. Okay? Cool. We're going to get into that a little bit more. Basically, if we're going to be talking about, because what I have on the board here is referring just to permanent life insurance. Term life insurance is pretty interesting. You know, it's simply like renting a house or renting an apartment. You don't actually own it. You never will, unless you do what? You buy that bad boy, okay, and own it. I'm someone that I prefer to own things. Not everything. I want to leverage. When it comes to life insurance, unfortunately, the idea with term is that it's real cheap now. But when you really need it in 20 years, oh my God, that thing shoots up in price. Okay? Mr. Mick says, why would I want to do this over a 401k? Okay? Very simple. Personal preference, history, following what successful people do. Okay? I've never met a person that is a multi-millionaire that said that 401k was their gateway drug. so to speak, in finance. I've never met anyone, I've never spoke to any household so far that can honestly tell me that a 401k has supplied their financial dreams. Not one. You know what I have heard? I lose money, it costs too much, the money's locked up till I'm 59 and a half. Very difficult for me as a 23-year-old to believe in that concept when I look at history and I'm like, damn, man, in '08, every single one of yous that had 401k lost half of it. What makes you think that I want to join that? I don't want to join that league of people that lose money. What has Uncle G said? Don't lose money. How do you not lose money? By educating yourself. That's why we're doing this right here. That's why we're figuring out, analyzing this concept. Okay. Let's see. I'm gonna stop it in a second. I'm gonna do like 2 more questions, and we're gonna go into a little bit more on the companies, and then we're gonna dissect the actual product itself. We're gonna talk about term. We're gonna talk about whole life, and we're gonna talk about universal life, IUL. Okay, because it's very important to know these things. All right. 401k is long term, and you get penalized for drawing money out. Then the balance goes down, and you only earn interest on the remaining balance. Correct. I like this guy. Okay. Loretta says you lose money left and right in a 401k. I think she's speaking from experience, but who am I? All right. Let's see. Debbie says, can the MEC change if you're able to contribute more as cash flow increases? Okay, no. Once you set the MEC, that's it. Which is why you need to think it through as to when we're doing velocity banking together, I'm pretty much telling you, hey, conservatively, when we're debt free, or if we're currently debt free now, based on the cash flow you have and based on, income increases, the economy, things like that, you're going to steadily make more money. So I think a safe number to go with is to either double or triple the amount that you're currently putting in. So if you're currently setting it up to put in 10,000 a year, 20,000 a year, just double it. That's like a safe way to do it. Or you can go as high as triple it. And you want to base this off your career, off your line of work. If you're working in food and beverage, I'm not sure if you're going to be able to put in triple the amount that you're doing right now. Okay? Working, in the restaurant or being a waiter or party host. Okay, at some point you want to level up. You want to get to the next level. You want to own the restaurant. You want to run the restaurant. You want to franchise the restaurant. Then we can start talking double and triple contributions, okay? So let's dive into the different types of companies. What is out there? Okay, who's doing what, right? So when I went through YouTube and I Google and I research, I'm like, all right, it seems like everybody and their mama is talking about Penn Mutual, PHP, People Helping People, WFG, World Financial Group, Transamerica, Lafayette, and the rest are not even worth putting on the board because their assets are not that high. Transamerica right here is a big one. I think they have about $1 trillion under assets, so they're pretty strong. Okay. Penn Mutual is a very, very popular one amongst, like the Wealth Paradigm Life and the big YouTube channels that preach infinite banking concept, that say they're with Nelson Nash, but I would beg to differ. All right. So I'm like wondering, why are these guys promoting so much with these companies? Is it because they're really good companies? which I'm pretty sure they are, but are these companies good for this concept? It might be good for something else, right? And I wouldn't doubt that at all. They're probably good for something else, but are they the best for this? For this, okay? And then there's a small, I mean so small, finite group of people that are saying four majors. They're referring to Mass Mutual, Guardian, New York Life, and Northwestern Mutual. These guys, according to their balance sheets, their revenues, their assets under management, financial strength, time in business, right? Well over almost 2 centuries, pretty much, like really almost 2 centuries with these companies right here. I begin to wonder, you know, why are these so popular and why are these so not? And I always refer back to, like, whenever I'm thinking about, my own personal life and when I'm getting information, right? What I was asking one of the people in the chat room earlier is, where do you get your information from, Mr. Carl? Right? Where do we get our information from? Are you learning from, you walk into the church and are you only listening to what the pastor says in the pulpit? Or are you reading the word? Is the word matching up with what the preacher says in the pulpit? Same thing with finances, right? You take a look at a guy like maybe Grant Cardone, Tony Robbins, John Maxwell, Jim Rohn, the big guys, right, in the space of personal development and self-help entrepreneur. Is what they're saying consistent, coherent, equivalent to previous successful entrepreneurs? Are they an example of what it is to be wealthy, rich, just financially prosperous, cheerful giver? Are they displaying those actions? If so, I think they're onto something. So it's the same thing when we're looking at a concept like this. Is, okay, on this side, we can agree that there's just not a whole lot of people talking about it, and I wonder why. And then everyone's on this side. So what I come to the conclusion is, as a licensed life insurance agent, I did my homework. I said, well, how much money can I make? Not the customer. How much money can I, the life insurance agent, make selling one of these policies? Penn Mutual, I think, pays right around like 90% commission, 100% or more. WFG, PHP, they not only sell you a policy, but they also sell you a business attached to it. So there's a lot of freaking money to be made with them. Transamerica, the same thing. I think they pay over 100%. Lafayette, same thing. So when I say 100%, 90%, what am I referring to? I'm referring to the actual cost of life insurance, the premium cost. So I'm like, well, let me just go with these guys because I am making a lot of money with them. But are you, the customer, are you happy with the policy that you have obtained? Has it performed the way the illustration was provided by your life insurance agent? If not, that's a tough conversation for the life insurance agent. Would you agree? So, me being me, I'm like, I trust in Christ. He is my source. I don't need to rely on maximization, trying to maximize me, because I understand the concept of what? Giving and receiving. So, if I trust in the deity of Christ as my source of everything, then, and if my purpose and focus in life is to help the customer, mom, right? Because that's who I truly want to serve, is moms all across the United States, helping them secure the household, man. getting dad on board, the husband, getting the children aligned, okay? If I can do that and still provide a great product, knowing that based on their performance and history and dividends, we're going to get somewhere, okay? So obviously you can put two and two together. Listen, I'm on this side. All the popular people are on this side. I'm not a popular guy. Don't want to be. I just want to serve my Jesus, okay, and help my moms get the money right, okay? Now, any questions on that? Specifically, let me look for some questions on that. Russell, how are you, Russell? The great thing about this is you can take policy loans against your cash value. We're going to get into that. Then you can pay yourself back like you would do with the bank. But now you're your own bank. And the cash value continues to grow. My friend, you are onto something amazing. Okay? Mr. Quinn says to Russell, not just pay yourself back, but you can pay yourself back with no or little interest. I'm going to go with no, Mr. Drake, if designed properly. Only if we design this properly. That is the key, Mr. Drake says. He says that is the key. So let's get into that part right there, which is perfect because it leads me into, okay, now that we are going to analyze and we're going to research and we're going to find which companies do we like most, who do I know, like, and trust on the agent side, what have I solved for everything, right? Now we have to determine the product itself. Do I go with term life, whole life, or IUL? Okay, we can eliminate term life because it's not a permanent policy and it does not offer cash value. So if it doesn't offer cash value, it's just an expense. Okay, it's just an expense, and it doesn't give me the ability to do velocity banking and have it function like a line of credito. Okay, so we're left with the whole life and the IUL. How do we make the decision? Whole life, the way you make the decision is based on where your money goes. What do I always tell you? Know where every dollar goes, right? Okay, so with whole life, money goes into two places: the premiums and the cashola. Okay, premiums, cashola, that's it, done deal, have a nice day. Okay, you got premiums, which is referring to the cost of the insurance. Cash is referring to the cash value of the account. So how does you and I, split the money up? Here's my golden rule. Here's what I've learned from successful individuals that have practiced this concept for many, many years and have designed many, many policies. They say, Denzel, the safe number, okay, you guys might want to write this down. The safe number to go with is a 75-25 split. Okay, that's safe. 75-25 split, meaning 75% going towards cash and 25% premium. Simple math, $10,000, putting it in, $2,500 a year is my premium, the rest in cash. Okay? Now, Denzel, what's the max? Because you know me, I could care less about that death benefit. What's the max amount of money that I can store into this bad boy? Okay? Can I put 100% towards cash value? No, not necessarily. You cannot do that. You know why? Because this is not an investment. Okay? So you cannot do that. Okay? The insurance company says, hey, Dr. D, you can do 90-10. Okay? That's the max that you can do. We'll let you put up to 90% of your money in cash and the other 10% in premiums. Okay? That is the max. So the next question poses, which is, well, Denzel, why on earth would I ever go with the 75-25 if I can do 90-10 and just grow all my money in cash? Here's the caveat. Remember I was telling you about the MEC? Very important tool right here. If you start out putting in $10,000 a year and you design a 90-10 split, okay, the best way that you'll reach this is going to also have to do with your age and health. So a guy like me, really, really healthy and young, should have no problem getting a 90-10 split here, okay? And still getting a decent death benefit amount, okay? Now, oh no, I lost my train of thought. Help me out, guys. Work with me, you know, I'm a young kid here, still learning my material. All right, okay, so the allocation of the money, the MEC. The reason why I might not do this 90-10 split is, again, if I'm putting in $10,000 a year, that means I got $9,000 going into cash value and only $1,000 going towards premium. Guess what? My MEC is going to be $10,000. Like, I have no space. Just like when we're doing velocity banking, you know how I always like to have space in your line of credit to prepare me for the next chunk and to avoid risk, right? Well, same thing here. When we were trying to solve for the ability, like Miss LIEN, right? Miss LIEN was asking Denzel, explain that ability there, man. And I'm like, look, here it is. Your ability to fund the policy is going to be based off the percentage that you put in the premium, okay? Your premium is going to have a direct correlation to the MEC. So is the MEC going to have a direct correlation to the death benefit, the face amount, okay? So if I design a policy with the 75-25, same number, 10,000, 2,500 in premium, and the rest going towards cash, and the insurance company says, hey, Denzel, based on your premiums, you are able to put in 10 times the amount of premium, which is your MEC, which would be the MEC. So you just take $2,500 times it by 10. What do you get? Is that 25,000? Can someone do the math for me? Because I'm terrible at math. What's 2,500 times 10? I think it's 25,000. Yeah, thank you. Cool. So my MEC would be 25,000. Okay. I'm putting in 10 initially. My premium stays the same. My premium stays the same whether I put in 10,000 a year, 20,000 a year, 15,000 a year, 4,000 a year. I can put up and down, doesn't matter. As long as I satisfy the premium costs each and every year, my policy will never lapse. Okay? And here's another really good thing is we'll say, well, what about this, Denzel? Well, what if I put in 10,000 the first year and 5,000 the second year and I lose my job the third year? Would my policy lapse? The answer is no, because you've already pre-funded it 15 grand, right? And you had 2,500 go towards the premiums, okay? So technically, if for that 1 year that you had job loss and it took you 6 months to a year to get back into a new job or new career, then you could set your policy up to pay for itself, to keep it in force. So that's a good thing. It's a good thing, okay? Now, that is whole life in a nutshell. To recap, money goes into two places, premiums and cash, okay? A safe number when you're talking to maybe another insurance agent is if you tell them, hey, I want to put in 10,000 a year, and they come back to you with a $4,000 premium, you might want to consider, hey, I don't think I have the ability to put in that amount of money, that high mech limit. Why would I pay for a high mech if we can't reach it? Okay? So if I was to put my girlfriend on the spot, she wants to become a lawyer, a beautiful lawyer with many cases under her belt and many successes. So if she designs, or she already did, she designed her policy, $6,000 a year right now. If she can't meet the mech at the $18,000 range, would it make sense for her to have the policy initially? No, it wouldn't make sense. Now, it's okay for the first 2, 3, maybe 5 years that she just does 6, 6, 6, 6, maybe 7, maybe 9, maybe 10, right? Maybe 4, maybe 3, who knows? First couple years. But over the long haul of a 40-year funding period, and she never hits 15K, 12K, like close to the mech, then there's no point. No point in funding that thing, okay? So that's whole life in a nutshell, okay? Now, let's get on with Mr. Drake because he wants to get into the IUL part, all right? So here we go. IUL stands for Indexed Universal Life, or Universal Life, Universal Variable Life, Universal Variable Whole Life. Whoa, some terminology there, okay? They all basically mean that we are putting money in the stock market. We're doing this with binoculars. The life insurance company is going like this with the index, and they're like, okay, it's performing well. Let's pay Denzel. Oh, shoot, it's not performing well. Denzel doesn't make money, but he doesn't lose money. Okay? So they say. All right? Now, let's break it down. Money goes into three places. Tres. Premiums, cash, fees, additional expenses. Denzel, what the heck is that? Right? You know how, Denzel, you're always telling me to know where every dollar goes. So what the heck is that? I already know what premium is, right? Cost of the life insurance. And I already know what cash is, which is cash value. Well, what is that? Well, inside of an IUL policy, the premiums are not guaranteed to stay the same. They increase over time. Why? Well, it has to keep up with the assumed performance of these policies. So, the pitch that you should receive from an insurance agent that is selling you universal life is say, hey, Denzel, you could make 15% tax-free. You can make 18% tax-free average. Be careful. Be careful when people tell you average, man. You don't want to be average. Mr. Cardone says don't be average. Be obsessed. Okay? So, very, very key word there. A lot of financial advisors throw that word around. Average. Average. ROI. Be careful. Okay? So, the pitch is you can earn 15%, maybe 20%, and that's looking at the index, S&P 500 or other indexes out there. The fee is based on the actual cost of the money growing at that rate. Somebody has to be paid for making you that amount of money. Somebody. The broker, the manager, So first you got to pay the insurance agent, right? With your money. Your money that you put in goes to the life insurance company, okay? Then the life insurance company takes your money, satisfies the premiums, okay? That premium then pays who? The insurance agent that wrote you the policy, right? He gets his commission or she gets her commission. The rest of the money, most of it goes into the cash value, hopefully, to grow at this hopeful amount. It's not guaranteed, but it's hopeful, okay? And then you have an annual expense fee. Now, according to the research that I've done on the internet, looking at companies, having consultations with other gentlemen in this space, and then looking at actual, policies that break down the cost, I've seen anywhere from a 1% to as high as a 2% annual cost. Okay, 2%, 1 to 2%, maybe. I've seen as low as 0.75. I've seen as low as 0.75%. Okay, well, here's something interesting. Okay, this cost right here is annual, not a flat cost. And this goes back to knowing the difference between simple interest and amortized interest. Very, very important. Okay? This interest right here is basically amortized. Okay? So if you're putting in $10,000 a year into a policy and you have the allocation of satisfying the premium with the universal life, and then you have to have money be paid in additional fees, and then the money in cash, growing at this hopeful amount right here. Okay? Now, 1% of what? 1% of the account value, just like a 401k does you, right? And this is where people are like, yo, where the hell did my money go? It went towards fees. It's not necessarily that the account didn't perform. It's the fees and the cost. So what ends up happening is you just do 10,000 times 1%. What do you get? $100 first year? Okay. You do 10,000 and let's say you earned half of this amount, maybe 8%, 10%, and you earn the percentage rate. Okay, in the first year, you earn money and you put 10,000, okay, and you paid your fee. Second year, you fund it 10,000 again, you earn more interest, 1%. Do 1% times $20,000 times an interest rate that it earned. So if you had a total of 20,000 go into the policy, okay, right? Allocation, right? Some money went into premiums, some into cash, and then the expense fee. Would you agree with me that your year one annual expense is gonna be less than year two, right? So the first year is the cheapest year for an IUL policy. The second year, it goes up. The third year, it goes up again. So let's think this through logically. If I was putting in the same 10,000 every single year, but my cost continued to rise, do you think that your cost would catch up with your funding amount? Let me get a yes or a no. At some point, 10 years, 15 years, 20 years, even worse towards the end when you actually need a protection. Nikisha says yes. I would agree with Miss Wonderful Nikisha. Ruben says yes, unfortunately. Dimes and 20s. I like your name, Dimes and 20s. TV. It's a crispy name. Says yes. Carl says, then that sucks. Costs go up, that's a fail. Hey, that's your 401k, buddy. Right? That's your 401k. It's exactly how it performed. Okay, so the hype is, yo, we could earn 12% tax-free and 15 and 20 and yada yada. Even if you did earn that money year after year after year, guess what? You would, at some point, you would have to continue to fund the policy. Okay? And in my humble opinion, for my 45 and up individuals, I don't know if they want to fund an asset forever and ever. The idea is you want to fund something kind of like a business, like what Mr. Uncle G says, where he's like, you got a 10x, right? That's what he says. You got a 10x. Okay, cool. You're 10x in your life. You're building a business. And his main thing is you want to get to the point where your passive income surpasses your activity income. So no matter what, whether you were active 12 hours a day for a whole entire month, your passive income would still make more than your activity income. That right there is true financial freedom. True financial freedom. Okay. Carl says, now I have to worry about my pension lump sum when I retire. Yeah, it's called the Sandman, Mr. Sam, Uncle Sam. He's gonna go like this and take you for a ride. Just like your 401ks. As soon as you start doing that withdrawal, boy, they're gonna go like that. They say, hold up, I need my 30% tax. Hold up. All right, Mr. Boxing says, how can I benefit from a life insurance policy? I don't know if you covered in the stream. I'm at work. Yes, I would highly suggest you, hit replay on that and go from from the start. This is pure education. No sales pitch in here. Okay, this is where we are breaking this down. We are determining as a household. I want you to think of me as your adopted son. Okay? And we're hanging out. And you're getting to know me because you adopted me, right? And you want to show me some love. And I want to show you some love because you're taking care of me, okay? And I happen to be able to show you my love by giving you the amount of revelation knowledge that I received from the Lord on your personal finances. Okay? Cool. So, that is the primary differences based on just where your money goes. Okay? Now it's up to you to decide which would I rather go with, knowing the purpose, which is this is not an investment. I should treat this like a savings asset, right? I want to use it to hedge to do velocity banking with, right? You really want to play with this and see which one would make sense for you. By the way, the next question comes up, which is, well, what does whole life perform at? Okay, what is their performance? And then what is IUL performance? Okay, so I said that I've seen as high as 15 to 20% on the IUL. Their guarantee is 0. Okay, the guarantee is 0%. Or some have 1% or 2%. I've never seen higher than 2% guarantees with an IUL. I've never seen anything higher than 2%. So basically what they're saying is that, hey, Denzel, you're not going to lose money. Okay? But let's do the math. Let's do the math real quick. Hold on a minute. If I'm putting in $10,000 a year and I have X amount of dollars going towards premium, X amount of dollars going towards cash, and I have to pay a 1% to 2% annual fee that increases over time, would you come to the conclusion that your cost may overlap your guarantees and you end up losing money? Oh, all you need is 1 to 5 bad years. Can you come to the conclusion that based on the history of the stock market, you would agree that people lose money day in and day out all day long, right? I mean, that's the name of the game. You have to learn the stock market like system itself in order to avoid losing a significant amount of money. And I'm sure you can agree that the most amount of money is made in a down market. Why? Because if you're really smart, like some of my viewers that are traders, that do trade in Forex, options, futures, Bitcoin, cryptocurrency, stocks, right? The treasuries and the bonds and the this and the that, okay? For my guys that are in the trader space, investing in the market, you know best that in a downward curve market, right? When the curve is showing down, that is the best time to buy, right? You want to buy when supply meets demand, right? Right at that point, boom, curve goes down and you ride that wave down, ride it, right? And you just buy, 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 buy. While everyone is selling, they're selling off because, oh my God, the market's bad. You, the trader, are buying all that. You're like, eating it. Yeah, I want it. Give me, give me, give me. And then what? Then the news comes out. And they're like, hey, America, U.S. economy is booming. Everyone starts buying. What do? You sell. Here you go. Oh, you want to buy? Toma. There you go. Buy it. Okay? So that's how that works. Very simple. Buy low, sell high. Buy low, sell high. Meanwhile, your 401ks are buying when the market goes up and is selling when the market goes down. Yo, oye, padre, madre, mijo, son, brother, brethren, that don't make no sense. To buy high and sell low, that don't make no sense. Mr. Carl says, we'll be trading after retirement thanks to OTA. I'm an OTA student. Listen, OTA is where it's at. They really, I mean, if you really, really wanted to learn how to trade in stock market, futures, Forex, options, you know what? I think your best bet is to check out OTA. There's really not a lot of solidified schools. I mean, you've got all the gurus out there, right? But why not have like a whole university of successful individuals that traded at the New York Stock Exchange? Like, whoa, okay? So something to consider if you're on that side of the ball game. Now, here's the other interesting thing. A lot of my viewers that are traders, they get this still. They'll still get a life insurance policy. Why? To hedge when they lose money in the stock market, because a good trader knows that you will lose money. All you have to do is manage the risk. How much do you want to lose? And how much do you want to gain? Your risk versus reward, your stop and your loss, your profit and your take, right? All that good stuff. So we are, wow, we've been an hour. It's been an hour, class. Has this been valuable so far? You guys find this valuable so far? Comment below, please. Let me get your thoughts. I can keep going. You know me, I got energy, boy. God is like just pouring right here. And I'm just like, speaking it out. Cool, cool. Everyone's like, yeah, 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 valuable. So, after a simple analyzation, one class, it doesn't just take one, it takes a couple. I highly suggest, if you're a new viewer, if you're brand new to my channel, I have run real scenarios, real examples of policies using the infinite banking concept with whole life. Okay? The reason why I stick to whole life is because there's better guarantees for me in terms of the purpose of which I am doing this concept, is to guarantee my wealth, to guarantee savings, right? I don't want to lose money, or else my uncle is going to get mad at me, okay? Because he doesn't want me to lose money, right? So the next question is, well, what's the performance on the whole life? According to these companies right here, Mass Mutual, Guardian, New York Life, and Northwestern, I don't pay too much attention over here simply because I have not had the best experience. You try to talk to someone from WFG and they're just going to sell me a freaking business. I'm like, yo, I just want a policy. Like, can you talk to me? They're like, yeah, but I don't want to impress you, but I want to impress upon you that, when you start a business, you can make a ton of money and live the life that you want to live. And I'm like, yeah, I know. That's why I became an entrepreneur. And I am doing my own thing. And I love what I do. And if you would just show me how you design your policies, we can get somewhere. But, it's tough to get like the core data sometimes. Same thing with PHP, man. I did my best. I spoke to them. I reached out. I'm like, yo, here's my information. Here's what I do. Here's what I'm about. Can you show me a policy? Can you show me a real policy? Can you show me the performance over the last 10 years? Can you show me? Can you show me? Can you show me? And they're like, oh no, Denzel, you're playing games with us. Get games. Get games. I'm not playing games. I'm trying to get the data, bro. I'm a teacher. I'm not out here trying to debunk your product. I'm just trying to teach, man. That's it. Penn Mutual, I've gotten a lot of good information from Penn. I'll be honest with you. I've had a lot of good guys. Spoke to a gentleman with Wealth Paradigm Life, and I've spoken with another organization. There's another company called Banking Truth, I believe, which they do both, actually. Whole Life and Universal. It's a preference. Because at the end of the day, people are like, yo, man, I want that 15. I want that 15. And I'm like, cool, man, dog, go. I'll write it for you if that's what you want. But don't come at me when it don't perform. Don't come at me. I gave you the information, okay? Here's what I say when I'm talking with an individual that's like, yo, Denzel, why not Whole Life? I mean, why not IUL? Why not? Because I'm like, look, what if, okay, here's great for all the 75 people that stay to the end. Because you know how I am when I keep giving all the way up to the very, very end. Why not, if you're so concerned about the high performance, because that's really all it is. It's not the product itself, it's the performance. Just like over here, it's the performance. Whole Life performs anywhere from 4 to 6.5% or higher. The reason why I say or higher is because right now we're in an economic time where interest rates are fairly low, very low. Matter of fact, they're almost at zero. Okay, that's why your savings account aren't doing anything. Okay, so when the interest rates go up, guess what else goes up? The performance of these types of assets. They'll go up with it, and then you'll be on the other side. You'll be like, yo, I don't care, man. Hey, interest rates went up. Cool. I don't care, man. I already got my line of credit. I already got my HELOC. Yo, man, it's cool. So you're on that side. But anyways, what if you could get the best of both worlds? What if you could get the best of both worlds? Meaning guaranteed premiums that will never change. Okay? A guaranteed interest rate of 4%. Okay? Tax-free, maximization on cash value, with the ability to earn up to 12.5%. Okay? That, my friend, right here, this company called Guardian, is combating with the IUL world. And they're like, you know what? I wonder who came up with this stuff. You know what I mean? Like, I want to meet that guy or gal that came up with all this stuff. And I'd be like, man, how did you do that? Like, that's amazing, right? How they think of this stuff, these rich people, man, is crazy, crazy. Anyways, best of both worlds, meaning my premiums are fixed. They won't go up. Whereas in an IUL, the premiums do go up based on something called ART. Write that down. ART stands for Annual Renewable Term Life Insurance. Okay? Have you ever been told that Whole Life and IUL are too expensive? Have you ever heard that before? They're like, yo, this stuff is too much, right? Dave Ramsey says, you could get 20 times more value getting a term life for the same dollars and whatever, however math he works out with. I don't know. I don't know if he's, speaking through, what, or telling the truth. I don't know. But what I can tell you is that you are correct on the standpoint, on the notion that in the beginning of funding any type of life insurance policy, term life will always be the cheapest in the beginning. Towards the end, different story. Okay? So how does one minimize, how do we truly minimize the cost of premiums on both sides? Okay? And that is, guess what? With term. A term rider. Okay? A term rider. With a term rider, I get the best of both worlds. I'm able to get that death benefit up to satisfy a mech that will allow me to put a certain amount of dollars in, and I don't have to pay for the high cost of premiums. And I just settle for the cash, which is what we want at the end of the day, right? The death benefit we don't care about. Death benefit is not going to you and I. It's going to your heirs. You just want to make sure it's there, okay? Now, the other thing on the best of both worlds is I get the guarantee of the 4% flat rate. Okay, IUL was at 1 or 2% or 0. Over here on whole life, it's 4 to 6.5 or higher. Over here, it's 4 guaranteed. Okay, and then what they do is what the IUL does is you can allocate money in the index. Okay, and they give you a cap. Okay, a cap is, hey, no mas. Basically, that's what that means. It's a cap. Put a cap on it. That's it. You can't earn no more than what we say. Okay, some IULs are designed that way, where the caps are 15%, 20%. Some IULs have no caps. Okay, no telling how much you can earn. Cool. That's pretty hopeful. It's not guaranteed, but it's pretty hopeful. Okay, so recap. Premiums are guaranteed, stay the same. You get the term rider to minimize the cost of the actual premium to maximize on the cash value dollars. You get the guarantee of the 4%, and the money goes in the index where you can earn up to 12.5%. And that might seem attractive. You might be, someone's like, okay, Denzel, now you're talking. Okay, now you're talking. And I'm like, hey, it's a preference. Mira, I'm over here. My own personal policy, I stayed right here. Okay? I don't care about no index, bro. Why? Because I'm going to follow suit with what Uncle G did and built a real estate empire with his wife. How cool. I can do the same. If he can do it, I can do it. Okay? I'm just going to break it down to my lifestyle. I simply want to acquire a piece of land in all 50 states just to say that I own a piece of land in all 50 states. And then that land is going to grow over value whether I or someone on my team or someone in this community, my real estate investors, my realtors, my real estate agents, are going to say, hey, Denzel, I'd like to build on your land. I'd be like, oh yeah, let's go, let's build. Cool. And then you build on my land, and then I just collect a paycheck. That's it. Just pay me a consistent revenue, residual income. I don't care about the big profit. You can just pay me a residual. I'm cool with just a residual, right? And we go from there. And then, over time, in a couple of years, I mean, I'm gonna be playing around with the Airbnb game, and then rentals, copying what Grant did. Just get a bunch of rentals. Millennials cannot afford homes right now. We cannot afford a mortgage. Our mortgage is student loans. That's our new mortgage. So until that system collapses, we're not buying, we're renting. Renting everything, right? Hence, that's why the country is in so much debt and has so many issues, because we don't trust in Christ and we're not following what he says, and we're trying to do things our way because we think we're somewhat smarter than God himself, which is unfortunate. So to wrap things up, any questions at all, I want to open it up more for dialogue, okay? And see what you guys have to say. By the way, if you're someone that has watched, whether now, a day from now, a couple weeks from now, you watch this thoroughly and you're like, you know what? I like this guy. I am a life insurance agent in the state of Florida, okay? I have a team of insurance agents. I'm a part of an insurance agency, a well-designed insurance agency with practitioners that know how to design policies based on this concept, and they're licensed in all 50 states. So therefore, I'm able to help anyone in any of the United States. Okay? Any questions? I wish I knew this 30 years ago when I purchased life insurance. Hey man, you know, it ain't over. It ain't over, man. Let me tell you. You start doing velocity banking with me, right? And you start getting the hips back. You're like, wow. You get the hips back and you start doing some salsa with the wife. Craig says, great info, brother. Thanks from the Callaways. God bless you. Carl, New York referral. Appreciated, sir. Very welcome. Vito Tech, is the cash value safe from Medicaid? Medicaid 5-year look back. Can you add a long-term care benefit? Yeah, that's a rider. If you want to pay for the rider, cool. We can add riders. That's fine. Okay, those are little costs each and every year. But if that's something that you want, we can design it where you can have a rider. Okay, really, really cool. I don't think I understood your first question on the look back part. If you're referring to, okay, if I fund a policy, I'm putting in 6,000 a year, my MEC is like 18,000, 15,000 or whatever. Can I make up for year 1, year 2, year 3? Like, can I make up for those lost years? Yes, you can. Yes, you can. Okay, Ruben says, feels like the standard for employers is providing 401k matching profit sharing. Is there no way to move that money without the losses from Uncle Sam? Okay, yes, there is a way. Write this down. It's called a 72T distribution. Look that up, 72T distribution calculator. That is a way to pull money out of a qualified retirement account without getting the penalty fee, that 10% penalty fee. You still have to pay income tax. You cannot get around income tax. Trust me. I don't know how. I mean, unless, you know my Colombian friends. Maybe we could do something, But other than that, I don't know, man. About avoiding income tax. I know we can avoid the penalty. Okay, maybe Denzel can invite a time machine. LOL. Yeah, man. Okay, spend down to qualify for nursing home. That's what I mean by down. I still don't understand. Maybe I answered the question though, as referring to the look back. Okay, ATV, can a veteran group life insurance policy be used for infinite banking? Group life insurance? No, because you're probably not the owner of that group life insurance. I'm not 100% educated on group life insurance, but I'm assuming if I'm in a group, we all share ownership in that life insurance. So the odds of me pulling cash out, to actually, do the infinite banking concept, to actually do velocity banking, I don't know, senor. Let's see. Velocity banking, the explanation of a non-investment whole life policy, priceless. Learning this at 52 years old. Amen. When you match, I don't think anyone's doing this. Velocity banking and infinite banking. When you match the two, oh wow. I mean, you get in your little corner. You're like, oh my God, I hope the IRS doesn't get me, man, because this thing is not. I don't know, man. It's legal, but it don't feel legal. Like I feel like I'm getting a one-upper every single time on the IRS if I do this. And then I mean that's just like what Uncle G talks about, man. He's always sticking it to the man when it comes to the IRS, and you should. This is a capitalist country, an entrepreneurship type of country, right? The tax code has been written to supply and benefit the wealthy. You can't get around that. Can't get around that. I'll be talking to you about this in about 5 or 6 months once my last debts are paid off. Just found out that my student loan will be forgiven after 10 years. Nice. Nice. There's a lot of velocity banking strategies where I almost don't tackle the student loans right away, simply because I'm betting that I might get that student loan forgiveness. Now, if it was a private student loan, then different story, because can't nobody pay that but you. You can, yeah, I can't wait to do both. Okay, you get life insurance in your name or corporate LLC trust. I get life insurance in my name. This is regarding, remember, personal finances. That's what this channel is always going to be about. Your personal finances. Not once, probably for the next few years, I am not going to stand here and try to teach someone how to make money or how to invest money, because I myself have never successfully, consistently done that, right? So I'm not going to speak until I can speak from experience. That's something that Grant Cardone did, and I think that's why he's so successful to this day, because he only speaks from experience. He's not a guru. I don't consider him a guru. I consider him Uncle G. Okay, got to get back to work. Thanks for running this video long. Thanks for sharing your gift, brother. You know it. Get back to work. Get in the hustle. Get your money right. Let's go. Great info. Also earlier on today on the Ultra FICO score. Just keep learning, watching your vids. Love it, love it. Should I become debt-free before using this method? Preferably. Now, it does depend on your cash flow. Like I said earlier, if you're cash flowing like $1,500 or more, $2,000 or more per month, then we could simply allocate like $400 or $500, $600, and still do velocity banking and get phenomenal results. Okay? Okay, velocity banking, infinite banking, and business credit will put you on another stratosphere. Oh my God, you are correct. You are correct. All right, I am going to close out. This has been an extensive class, and we have done a lot today. I think we accomplished a lot together. I want to thank you for spending some time with me. I wish you all a wonderful evening. God bless, and be talking to you soon. Content